Hi, good evening, everyone, and thank you for taking the time to join me today. I am just going to be waiting for another 1 or 2 minutes for more people to join, and then we will begin. So, for those of you who I have not met me before, my name is Sara Waqar, and I have spent over a decade in the financial markets as a proprietary trader and as an educationist with a primary focus on currencies, commodities, and stock indices. So I hold a double master's in economics and finance. I'm also licensed from FINRA USA, as well as being accredited through CC and as an investment manager, which is aligned with the UAE ESCA regulatory standards. Over the years, I have worked very closely with brokers, with investors, and I help them translate macroeconomic developments into practical trading insights. I've also been involved in financial journalism, including investigating fraud cases for Gulf News, which gives me a deeper perspective on the risks that exist in this industry. Since the last 10 years, I've been running professional trading courses, working with individuals from all backgrounds to build disciplined approach to the markets and focusing not just on trading opportunities, but also on risk management and trading discipline. So I think that many of you must be familiar with Amana, which is has been there for the last 15 years. It's a big name in the market. Amana is a non-traditional brokerage which has multiple regulations, which are both local and international. So this is our entire regulatory umbrella. We have local regulations such as ESCA and DFSA. And then we have the European regulation, SISEC, we have the Lebanese regulation, and regulations from Mauritius and from Malaysia. We have a specialized focus on the MENA region, and worldwide we have over 100,000 active traders. We offer around 5,500 financial instruments, which range from global equities to MENA equities, to digital assets, as well as Forex commodities and indices. So we have a wide a range of offerings, all from a single platform. So before I go into today's topic, which is actually a very interesting topic, and it's really related to the current geopolitical events, I would like to encourage you all to drop your questions in the Q&A section. So you see a Q&A section below. You can drop your questions in the Q&A section, and I will try to answer them as we progress through the webinar, okay? Also, if you have any queries, you can email us at support@amana.app. So, all right. I am going to begin with a very simple question. What happens to the global economy if 20% of the world's oil supply suddenly gets choked? Not gradually, not over months, but quite suddenly. And that is exactly what we are going to talk about today. The Strait of Hormuz is actually not just a geopolitical headline. It's one of the most important pressure points in the entire global financial system. And when something like that escalates, it just does not move oil, it also moves all other markets. So there are spillover effects on currencies, on equities, on commodities, on inflation expectations, central bank decisions, everything. And that causes a massive reallocation of capital, and it calls for all investors to reevaluate their investment and financial decisions. So today I'm going to be talking about why the Hormuz supply shock is so critical, what happens to markets and to capital flows when it's disrupted, and most importantly, how as a trader you are supposed to behave in this situation, how you can position, how you can manage your risk, and how you can avoid getting caught on the wrong side of volatility. So before I go into the dynamics of how we should be trading and looking at oil in this situation, I want to give you a background. And we're going to start with the foundation, which is very important for you to understand. Now, we know that the Strait of Hormuz is a narrow shipping lane, which is about 33 kilometers wide, and it sits between Iran and Oman. But the key thing to remember is that every day, about 20 million barrels of oil pass through this single choke point, okay? Which is about 20% of global oil consumption. And it is not just oil, it's also 20% of the LNG flows, which move through this route. So we're not just talking about crude, we are talking about the gas markets being exposed as well. So the annual value of energy, as you can see in front of you, passing through this route is 600 billion, which is a really big figure. So as you all know that on the 28th of February, strikes on the Iranian nuclear facilities triggered a block of the Strait of Hormuz. And the shipping traffic actually collapsed to 10%. So we had about 3,000 ships per month passing, and now it is down to below 300. And then we saw the steepest rally since 2008 in oil prices, which was about a 74% surge. So what is the extent of this supply shock? So this supply shock would about 1 billion barrels being lost by the end of April if the current situation continues, which is actually, like I said, it's the biggest oil shock that we have seen. So again, if we talk about the ripple effects, it's creating ripple effects across multiple global supply chains because, it's one of the world's most critical maritime choke points. We are experiencing delays in consumer goods, in higher freight costs because ships must reroute around Africa, adding time, and fuel costs are rising. Then we also know that petrochemical supply is getting affected. This is going to the packaging industry, to the automotive, to consumer manufacturing as well. We are looking at rising prices of plastics globally, not just fuel. And Gulf countries like UAE, Qatar, or Kuwait rely heavily on imports through the Hormuz. So disruptions could lead to, if this continues, which we hope it will not, then it could lead to some grain shortages and higher food prices locally. So yeah, in front of you is a slide which is showing you all the possible effects, the economic effects and the economic chain, which is going to result from this supply shock. Okay. Also, we have, many medicines and raw materials which are shipped through the Gulf route. So the disruption is going to cause delay in a lot of medical equipment, critical drugs. Then we have, air freight, which so the airlines are going to face airspace tensions, rerouting, longer flight times, more insurance, higher insurance costs, rising construction costs, war risk, insurance premiums increasing. So actually, the bigger picture is that even though oil and LNG dominates the headlines, the real systematic risk is that the Strait of Hormuz is a multi-commodity artery, and we will be seeing the effects, and we are actually seeing the effects through so many different industries. So it's also chemicals, it's also food, manufactured goods, industrial inputs. It's because all of these supply chains are interconnected, so disruptions quickly have already spread over multiple unrelated industries. So what actually happens is when this supply shock hits the market, the first and the most obvious is the rising price of oil. We know we've seen very fast rallies in oil since 2008, and we know that oil does not move in a smooth trend during geopolitical events. It's going to gap, it spikes, there's volatility because this is not demand driven, this is a supply shock. And like I said, we are looking at almost 1 billion barrels lost over time if these disruptions persist. So once again, the chain reaction is going to be the crude oil spiking, the transportation costs rising, the fertilizer, food, and energy rising, feeding directly into inflation. And then, if the inflation rises, the central banks do not feel free to cut rates because they need to control inflation. So suddenly, a geopolitical event turns into a monetary policy problem. And very soon, we could be seeing stagflation, which means low economic growth, high unemployment, and high inflation. So you also see effects across different asset classes, which means that equities would struggle because the companies could see a squeeze in their profit margins, and we could see a lot of flows into gold, which is going to obviously act as a safe haven at this time. Okay. So if we talk about dependency, we know that China buys 90% of Iran's exported oil, and Europe also relies on the Hormuz LNG. And what that means is that when this disruption happens, the reaction is synchronized across the all across the globe. So a lot of people assume that if something happens, supply can just be rerouted, but this is not as simple because when you look at the alternatives, for example, if you look at the Saudi East-West pipeline, which is producing 5 million barrels per day, and then we have the UAE Fujairah pipeline, which is 1.5 million barrels, this does not come close to replacing the Hormuz flows. So what you are looking at is you're looking at a supply drop of 8 to 10 million barrels per day, which is quite massive, and that is a big structural shock. Again, what is triggering is this is not a full closure, but it's just perception. It's the escalation, the military strikes, the rising tensions, the threats, the insurance premium spiking, the shipping slowing down. So markets are all of this information in. So moving on to the specifications of how we can take advantage of. We basically have two kinds of oil that are usually traded. Okay. There are other regional types of oil as well, but the two most common types are called at WTI. Okay. So when we usually talk about oil, we are talking about the Brent crude. So when you hear in the news that, okay, oil if the escalations continue, oil might hit $150 per barrel. This oil is Brent. Brent is being referred to usually. Now, this is the global benchmark. It's the North Sea oil. It's extracted between UK and Norway. It's the global benchmark. It's used to price two-thirds of the world oil. It's easier to ship internationally. It's very sensitive to global logistics. So during a Hormuz disruption, Brent is expected to carry most of the geopolitical premium. The other oil is WTI, which is West Texas Intermediate. Short form is WTI crude. So this is the US oil, and it originates from inland Texas. It is called light sweet crude oil, and this is also traded, but it's more of reflective of the US economy. It's a benchmark for US oil prices, and it's landlocked. So usually Brent has historically traded a little higher than WTI because Brent is on water, it's easy global shipping, and WTI is inland. And we have Brent is reflecting global demand supply, whereas WTI is reflecting US specific conditions. So the geopolitical events are expected to impact Brent more directly than WTI. But as you will see, as what we have seen in the past few days is that WTI has actually also reacted to this geopolitical situation, and both of these types of oil have become expensive. So actually, there was a time about 8-10 days ago when the spread between them both was just $1, which means that people were pricing them almost. And what is the reason for that? The reason is that, the tensions around the Strait of Hormuz and the broader Middle Eastern risks, they have affected the global supply expectations. So that is why WTI has become very close to Brent. And so all the markets are exposed, and the markets are now pricing the risk into all of the crude benchmarks, not just Brent. Okay. I think that the logistics in US are today better, so inventories are being better managed, and WTI is moving. It's now the flow is much easier to the global markets. So in a sense, the differences between both of kind of oils are not that much anymore. So hence the prices are the spread or the price difference between them is almost very less. It's now maybe on an average of $3. So usually in such a situation, a lot of traders do arbitrage, which means that, if they see the spread between them increasing, they will buy W2I and sell Brent so that because they expect the gap to become smaller. And this is how they will gain. So this is just one arbitrage strategy. I now want to go to the trading platform and I want to get into the actual dynamics of trading. So I will, encourage all of you to ask me questions along the way. If there is anything that you want clarity for, then, I can always do that. So please post your questions in the Q&A section below. So this is the Amana trading platform. If you want to access it, you have to go to web.amana.app. You have to create your login credentials and go through a process of KYC. You have to upload your uh, identification documents. It's a very easy process, and the sales team will help you and guide you through this process. Once your account is approved, you get access to this platform. After that, you can just deposit. You can fund this platform using different modes of payment, such as credit or debit card, bank transfer. Even crypto deposits are fine, and other payments such as Net, Teller, and Script. So after the onboarding process, you will get access, and this is the main interface. Just to clarify, this is a For You section, which is showing you the top movers, educational videos, what is trending, and upcoming economic announcements. So here, if you go to trade on the top right corner, you will find, that you can actually display different charts of your favorite instruments. So this is my watch list here. So it's very easy to add something to the watch list if you just go to the search button here, and if you search for anything such as Tesla, and then you just press star here and it will be added to your watch list, so you can keep a close eye on this. So similarly, this is my watch list, and here I have both Brent USD and I have WTI USD here. So as you can see, Brent is trading at $94 per barrel at the moment, and WTI is trading at $90.8. So that's about a $4 difference between both of them. Now, one question that might come into your mind is, which oil should you trade? Should you trade Brent or WTI? And what is easier to trade? So in my opinion, both, it does not matter what you trade because both exhibit very similar trends. So it is really up to you if you want to trade Brent or if you want to trade WTI. Okay. Okay. Now going into the specifics, I just described to you that this price that you see here, WTI, this is dollars per barrel. So here 90.8 means 1 barrel is equal to $90. After I have selected this instrument, if I scroll down on this window, I'm going to see more details about WTI. So after having selected it, I scroll down and I will see the performance of WTI. So here it is showing me the performance of today. So today it was up by 2.6%. The 5-day performance, the 1 month, the 3 month, the 6 month, and the 1 year. And here you get an in-depth analysis of the long-term and the short-term movements of this particular instrument, which in this case is WTI. So as you can see that because of this big surge, this oil shock, it is recording in the past 3 months an increase of 52% in the price. If you go further down, you will see the details. You will see the spread, which is the difference between the buy and the sell. selling prices, the leverage, which I'm sure most of you know. So right now the leverage is 1 to 50. You can also change this leverage by pressing this button change. So this will send an email to our team and then they can approve. If you want a higher or lower leverage, they can always approve that for you. Similarly, you can do the same thing for Brent. So I'm not going to go through this. Okay. So what I'm going to now focus on is looking at the trend and what we can do, how we can actually make money, which is the most important question, which is why you're here. How can we make money from this situation and in a safe way and in an effective way? So this in front of you is the price chart for Brent. And I'm going to change this here from the 4 hourly to the daily, which is my favorite time frame. So the daily time frame, as most of you would know, here one candlestick shows you the activity of one day. On the horizontal time scale, I can see the prices from November to April. So I ideally like to see a cycle of 5 to 6 months, which gives me a broader macroeconomic perspective of how this market is doing. I know that some of you might be into short-term trading as well, or scalpers or so on, but in my view and my opinion, if you have to really form a proper long-term perspective of the market, it's very important to take a look at the daily time frame, and that is going to give you a broader and a smarter perspective of that market. So right in front of you, you can see this big surge, which was the supply shock. So we saw prices going up from 70 very rapidly and actually going up to almost 114 or 115 for Brent. This was a very volatile and spiky day. However, prices did not close at 115 and they came all the way down on this day and closed at 96. So this was extreme volatility right here. So what is happening right now? If I look at this market, I will conclude that this does look like the market is in an overall uptrend. But right now, this area here is suggesting me a range. So what is a range-bound market? A range-bound market is a market which has a lower ceiling, a price floor, and which has an upper bound or a resistance. So whenever it climbs up to that resistance, it is unable to cross it. It comes down, it reaches the price floor, but then it also bounces off the price floor. So if I have to make this more visual for you, I will take this horizontal line tool and I am going to draw a line here. So I'm going to draw an average line which represents the price floor or the ceiling in the past 2 months or roughly 6 weeks. And yes, you might question that why I have put the line here. So actually what I'm doing is I see the bunch of candles here and I am trying to draw an average price line for this particular level. And I will not put the line below the tail of this candle because again, I'm trying to find an average of this bunch of prices here. Okay. So this is again an approximation. It is not an exact value. If it has to be a zone, then I can look at this zone as a support zone. So I can look at this support zone as being between 85 to 90. So it seems that at the moment, this is the place where the price of oil has found support. So whenever it kind of hits this level, it has a tendency to bounce upwards. And that is definitely due to the current situation right now. What about the upper bound? The upper bound is given by one of the upper bound, as we know, is the very top of this candle. So the prices have actually reached 114. However, if I am to take an average, then I would rather draw the line somewhere here. Okay, because what I want to do is I want this line to touch the maximum number of candles, not just one candle, but the maximum number of candles. So I will just put it here. So this is just again an approximate. So this is a resistance zone and this is a support zone. So let me try to make this more simple. So from the technicals, what I see is when oil comes down between 85 to 90, it has this tendency to move up. But when it reaches between 108 to $114, then it has a tendency to move down. So as of now, I see this as a range-bound market, and I see that opportunity that if you find the right price action, bullish price action at the support zone, then it would be a good opportunity to buy. But if you find negative price action or bearish price action at the resistance zone, that's an opportunity to sell. Now, of course, this is the most plausible scenario, and this is a scenario where I'm assuming that there is no further de-escalation and there is no further escalation as well. Because if there is further escalation, then there is even a chance that this resistance zone is broken, and then we are seeing prices move from 114, which was the last highest point, to even 130 or even 150. But again, the scenario when there is, very visible escalation, which we hope will not happen. And the other scenario could be very, very visible de-escalation or a complete ceasefire, which again, it does not seem plausible at the moment. But then in that case, what would happen is we could see price resting in the support zone, which is between 85 to 90 approximately. Again, this is not exact values, these are approximate values, okay? And then we might even see, in the case of a complete ceasefire, prices might drop further. Again, this is not a recommendation or an advice. It is just, an analysis that I'm doing to try and help you to understand what, as traders, how you can trade oil and what kind of positions you can take. So the most important thing that I want to stress right now is the risk management. So this is not separate from risk management. And as you know, there can be a lot of price gaps because of the volatility. So you have to be very careful. You have to be careful to put your stop losses in place. You have to be careful to manage your risk meticulously. For beginners, I recommend not taking more than 2% per trade risk on your account. So for example, if you have a $50,000 account, do not take more than $1,000 risk per trade. That's for beginners. Obviously, if you're experienced, you can increase your risk level. Then it also matters how many trades are open at one point in time. So your total exposure should not, in any case, be more than 10% of the account's value, which is, in my opinion, also high. But sometimes, yes, you see very good opportunities and you want to capitalize on them. However, market analysis is never separate from risk management. So again, let me give you an example of how I would place a trade on oil. Okay. So if I click here, let's place a trade on Brent. So you can click here on buy, right? Because we see we're around the support area and we might hope for prices to go up to, let's say, from 94 to 104. So $10 up, okay? Supposing we will press buy. Now you will see this panel opening, and it gives you the option to either enter the amount, which is basically your margin. So if I enter, for example, 200 here, and the leverage is 50, so 200 times 50 is what is the value of my actual position, which is $10,000. So I'm buying oil worth of $10,000. The exposure here tells you that you are buying oil worth $10,000. Again, this amount is your margin, or this is just because your leverage is 1 to 50, this margin is actually 2% of your total exposure. So you have to understand this amount is your margin. It's not your exposure. And then instead of amount, you can also put units here. So units are basically barrels. So I can change this to units and then I can just say that, okay, I want to trade 1000 barrels, for example, because, this account is, the value is right now $72,000. So I can take this position. I don't recommend taking this position again for any value, because you have to actually calculate your own risks according to your equities. And then you have to determine what position size is good for you, what position size keeps your account safe or restricts your risk to what you want. Okay. So this is just an example. Okay. So again, 1000 barrels of oil are equal to $95,000 right now, because one barrel is 94, trading at 94.9. I get the details of this trade here. Investing means this is my margin here. These are the overnight fees, and then I can just either trade it at market, or I can put a pending order, which can be a limit order or a stop order. So the market price is the current price at which Brent is trading. And if I just click on buy, it will buy at the current price, right? Which is 94. But if I want to specify a price at which I want this transaction to happen, for example, I feel that, okay, the prices tomorrow might dip down to from 94 to 91, and 91 would be a better price. Then I will just put 91 here, which is going to be a pending order. And then can also put a stop loss. So let's assume that I put a stop loss of, if I'm trading at market, I just put a stop loss of below this candle. So below this candle is 88. So I put a stop loss at 88. This means that if the price does not go as planned, then if the price drops down to 88, it will automatically book my losses and close my trade so that I will be saved from more losses. Similarly, you can put a take profit, which can be, let's say, 105, and then we just execute. And then you would be able to see your positions here if you go here, okay? And obviously it will start with negative because, this is the spread that you are paying to the broker, which is the difference between the buy and the ask. If you go here, you see three dots, and you have the options of partially closing your order as well as modifying your order. So when you go to modify, you can actually change your stop loss and your take profit here. And if you go to partial close, you can actually partially close your order. And that would usually be when you have made some profit, then you want to partially book your profit. So you have all these options here with you. And if you don't close it, then you have put a take profit, so it will automatically close your trade at the take profit level, which in this case is 105. So if you go under this activity panel, this will show you your history, your statement. So this is just showing you the trade that we have just taken. And also you have the option of putting any price alerts. So I could put the alerts from this here. So let's suppose that you want to be notified if the price reaches to 90, because you think you may want to take a trade at 9. When the price reaches 90, you will create an alert, and you would then be alerted through maybe an email or a push notification, so that you can take the necessary steps. Okay. And the analysis is very similar when it comes to also to WTI. In case of WTI, the prices are very similar. Again, approximately, we have the support zone again at almost the same prices, approximately $82 to $88 as the support zone, where if you find positive or bullish price action, it's a good time to get in and buy in between this zone or in between these levels. And again, this 107 to 108, and the top is for the resistance zone is 115. So in between this zone, if you get the bearish price action, it's good to sell. You can also do blind entries, which means that some people will just not check for any signs of the market being bullish or bearish, but they will just simply sell when the price reaches the resistance zone, or they will simply buy when the price reaches the support zone. But I think a much better way is to look for price signals which corroborate with the support or with the resistance. And that's something, price action is something that I've kept for another webinar. So it's a very big topic and it's a very in-depth topic. So I will be taking that up in the upcoming webinars. But I just want to give you one quick insight, which is that, if you look at these wicks, so an upper wick is definitely a bearish sign. So if I just zoom in and I look at this candle on the daily time frame and it has an upper wick, what this basically means is that on this particular day, prices tried to move up. They made a high. However, they were unable to close high and they were pushed down by sellers and they closed lower. So that left behind a wick. So that is essentially a price rejection, upward price rejection, which means prices in the coming days will develop a downward momentum, which is what you see later. And just right here, if you have a downward wick, that is actually a bullish sign. So yesterday we had a downward wick on a support level. So this is a point of confluence. You have a support level, you expect price to bounce up, and then you find the right price action, which is a bullish price action, which is this particular candle. And yes, it does not have the candle does not essentially have to be green to be bullish. This is one other nuance of price action, which I teach. It does not have to be green only to be bullish. It can be red, but it can still be bullish. So again, this candlestick is giving me a good, very strong signal that I should be buying at this support level because there's upward pressure right now. So again, if you have any questions, you please feel free to ask me in the Q&A section. Somebody has asked me what is the impact on the currency pairs, especially dollar yen. So actually, I'm not focusing on dollar on the currency pairs in this webinar, but I can just take a quick look to see what is happening on the dollar yen right now. So technically speaking, okay, I do not, right now the market is quite choppy and again, it's quite range bound for dollar yen. So we have an upper limit which is concentrating around 159 and we have a lower limit which is 157. So it is actually trading between this range. But if I look overall, I see that there might be an upward breakage because this a channel is being formed. So this particular range is becoming tighter with time, which might actually lead to an upward breakout. So this is what I mean. And then, so the range tends to become tighter. Sorry. So this is what I mean. The range is, this is a whole range. So this is a very sideways market. Again, I'm on the daily time frame because I always look at the daily to get, a broader perspective of the market. But because the overall trend is upward, we might see a breakout. So I hope that answers your question. So going back, we have just discussed this, that there can be three possible scenarios in oil. The range bound scenario, which is in the middle, which is what is happening right now because of the uncertainty. So if this mixed cues by politicians and the uncertainty continues, then we would probably be in this range between, broadly speaking, between 80 and 115. If, God forbid, there is more escalation on all of a sudden something very negative event, then definitely that this range could be broken. Some people would like to trade that with a stop order being placed above 115, so around 116 or 17, a buy stop order. But then that again depends on your strategy and how you would be viewing the market. And this is the least plausible scenario right now, which is most very successful negotiations and complete ceasefire and all that. Then we could see, oil trading, between 80 to 90, and below 80 is again something which I feel is not very, it does not look like it will happen right now, but we can just hope for the better. Again, this is the same thing that I have just spoken. These are the levels that you need to be watching out for. These are these very important levels that will determine the overall direction of oil. Again, what you have to focus on is you have to keep in mind that because of the volatility and the gaps in the market, you need to reduce your position sizes to accommodate those volatility, those gaps, and you need to have wider stop losses. Again, the stop loss should ideally be placed, if you're buying, it should be placed below the support zone. If you are selling, it should be ideally be placed above the resistance zone. Okay. So that is going to be the safest stop loss. For example, if you are buying, then the stop loss below 80, which is going to be the ideally the best stop loss. And if you're selling on the top of the range, then the ideal stop loss could be above 115 to keep you safe, which means that wider stop losses mean you have to reduce your position size. And of course, you can also do some kind of hedging by going into long positions in gold to offset drawdowns. If this doesn't have to be your only position. You can and you will definitely be trading in other markets such as the equities, indices. So S&P and Nasdaq are, there are very good opportunities and trends right now in those markets. There's excellent opportunities in gold and silver as well, which I will talk about in the coming sessions. So yes, this and oil, again, like we discussed today, is a very good opportunity if you are disciplined and obviously you are making sure that you are doing your risk management correctly. I have a question. Looking at the recent sequence of bars, where exactly did the momentum shift from impulsive to corrective, and which specific bar confirms that transition rather than, okay. Actually, I don't know which bars you are referring to. So I cannot answer, if you can just specify a level, then I can answer this question. But so again, the Strait of Hormuz is a binary switch. So if it's disrupted, oil goes significantly higher. If it stabilizes, prices are going to normalize, but there is uncertainty, and if there is no significant escalation or de-escalation, then it remains range bound. So I have talked about these important levels. 115 is the breakout, 84 is approximately 80 to 85 is the structural floor. And what you have to focus on, and with what is the most important rule, is that capital preservation is the most important thing. So you don't have to catch every move. That it's impossible to predict every move. It's impossible to catch every move. But what you have to focus on is to avoid any big losses and to preserve your capital first, which comes with risk management. And we are not actually dealing with any one small news or a news event. It's a very big structural risk to the entire global system. So whenever you have that kind of a risk, markets behave very unpredictably. They never behave normally. They're going to be faster. They're going to be more volatile. They are going to be less predictable. So your edge as a trader is going to be you managing your risk, you staying disciplined, you staying flexible, and you going in the market with a trading plan. So you have to protect your capital first because opportunities will always come. But capital, if you've lost it once, it's very hard to recover. I have a question. Which pivot point chart is the most accurate to specify the support and resistance points, as there are many? Classic, traditional, okay. So what I basically do is To be honest, I do not believe in using a lot of indicators like Fibonacci and this and that. I analyze or stress mainly on the candlesticks and the price action because I believe that price is the best predictor of itself. So there is nothing like a naked chart, what I call a naked chart, which is free of all indicators. And I understand that sometimes you need some kind of tools to help analyze a trend or a support or resistance level. But if you just trade to draw support and resistance lines on the higher time frames, I think that is the best way that you can do. So if I go back here and if you want me to specify how I can, how and why I'm drawing a support or resistance level in a certain way, I can just tell you that what I try to do here is that first of all, again, this should be a higher time frame. The ideal time frame is the daily time frame. You should be looking at least 3 to 4 months, and you should be giving priority to the last, 4 to 6 weeks over the previous data. So if I look here on this chart, I have these bunch of candles here, and the way that I will try and draw a support line is that I will try and maximize the number of candles that the line passes through. So again, this is something that is kind of intuitive and it comes with practice. See, I can see this line and I can see I've drawn a line where through which 5 wicks are passing. So this is a support line and 5 wicks are passing. So the maximum number of wicks are passing through this line. So this is a representative of an average support area for me. Again, if you want to just depict this as a zone, then I can put another line right below the wicks as well. So I will then call this a support zone. So I don't encourage the use of a lot of indicators like this together just to derive support and resistance lines. I hope that answers your question. So yes, somebody has asked if they can work with cryptocurrency in Amana. Yes, we have a wide range of cryptocurrency. We have all possible, digital currencies, and we offer both leveraged and unleveraged instruments. In fact, for everything, we have both leveraged as well as unleveraged or cash instruments available. Yes, one more thing is that, which I should have mentioned before, is that here the Brent and the WTI that I'm showing you, this is the spot oil. So we also have future contracts for WTI and for Brent. So if I write WTI, yes, so I have future contracts as well. For example, this is the Brent oil June contract here, and the Brent oil July contract, then the crude oil May and the crude oil June contract. Okay, so we also have the future contracts for trading. And for those who know about future contracts, is that this is the price of oil which is meant for future delivery in the months of June or July. But right now, I have just explained to you, how to trade, spot Brent and spot WTI. So this is the price of oil. For example, Brent oil June means the price of Brent, which is meant for delivery in June. And Brent oil July would mean the price of Brent, which is meant for delivery in July. And spot, which we looked at right now, would mean oil which is for delivery right now. Overnight, somebody has asked about overnight fees, why they are charged. So the overnight fees will be charged if you hold the trade for over 24 hours and if you are using a leveraged instrument. So the swap or the overnight fees are basically the interest rate that you pay because you are borrowing and you're using leverage. So the amount you can see here. So if you go here, if you click on the instrument and you scroll down, I think you can see it here. Yes, so the overnight fee is going to be, in this case, 0.08% of your total exposure. If you buy and if you sell, then you will 0.2% of your total position or your total exposure. So actually, if you here as well, for example, anything, then you will see how much this figure actually shows you that with this position size, you will be paying $7.69 of overnight fees if you hold overnight. And also, here, if you scroll down, you will be seeing the news, which is related to the particular instrument that you have selected. So if you have selected, for example, any instrument on top, so you will be seeing the news related to the energy stocks right below. So you will be able to, access the news and the educational sources all in the same platform, as well as the economic announcements. So the time for the webinar is over. I hope that this was informative, and I hope that it will help you make better trading decisions. Thank you so much for being here, and please stay connected with us, and you can always email us at support. This is the email address, support@amana.app. And thank you so much. So I will be seeing you next Thursday.